There is a lot that we want to ask you about. Perhaps to start with something simple. With or without a vaccine, the expectation is we will need more stimulus over the near term. I guess the question right now markets are grappling with is, do we need more monetary stimulus from central banks?
Well, it's not clear they have much more to give, right, on the monetary side, because they've basically cut rates to zero. They've bought a lot of assets, and they've offered support. The U.S. Fed is now offering support to corporate bond markets. It's unclear how much more they can do. So really, a lot of the thrust has to be on the fiscal side. The bridge that was erected over the pandemic has proven too short. The pandemic has been longer lasting than people expected. And so there is a demand that some of the unemployment insurance, the paycheck protection supports to small businesses, that those be extended so that you at least take it until the vaccine starts coming out.
The notion that we will definitely see growth rates pick up next year. You obviously have a very low base effect. We're coming off quite a year in 2020. What's your base case on when you think output is able to return to pre-COVID levels then?
Obviously, it varies from country to country, but my guess is most of the industrial world will see it return to the pre-COVID levels by the end of next year. And, sometime, the real issue is, how do you get back to that trend level and catch up with what it was before? And many countries are unlikely to do that. China may. But for many countries, especially the emerging markets, it's going to be much more difficult to get back to that trend level.
What do you think then, I guess it's the next question to that, are the permanent elements in terms of the structural damage you think the global economy has sustained this year?
Well, this is hard to tell right now because there's so much support that's being given. There are also various kinds of moratoria in place. People, for example, in the United States aren't getting evicted when they don't pay their rent. There's loan forbearance that the regulatory authorities have put in. So really, with all the support, it's hard to tell what the true level of damage is. My guess is as we start moving into the second half of next year, and as many of these supports come off, as the stored up cash that people have comes off, we will see what the sustainable level of growth is. And that will depend a lot on the scarring that has taken place so far. What is easy to say is the scarring is much higher in the emerging markets, which haven't been able to support small and medium enterprises or households as much as the industrial countries. The extent of fiscal and monetary support in industrial countries has been much higher, which means the effects on growth will be lower than in some of the emerging markets.
Yeah, and I guess since we're talking about fiscal support, we just heard from the Japanese government earlier, 700 billion. Getting back to trend growth, do we need to rethink what the trend growth is, Dr. Rajan, in terms of, we have a ton of debt that's been built up this year for good reason. Might that have a material drag on growth in the coming years, though?
Absolutely. So where is the drag going to come from? For sure, all the problems that were in place before the pandemic will continue with us. Western economies are aging. A number of Asian economies are also aging. That's reducing the size of the labor force, cutting into growth. There are also, productivity had been relatively low. That's a place where you may see a silver lining. Many firms are rethinking how they produce. Service businesses are reconfiguring how they produce. Manufacturing is thinking about that. So you may get some productivity boost from that, from the greater automation that some firms are embracing. But otherwise, you have the debt overhang, which is also going to be in place, many more corporations which are highly levered. That's going to slow growth. And of course, we had impediments to trade and investment even before the pandemic hit. And that's not going to go away quickly. It will take time to lift those. It will require negotiation. So my sense is, with all those effects, growth would have been slower even without the scarring. And if you add in the scarring, it is going to take some time. Potential growth for many emerging markets has been reduced.
Would that then be something that governments should consider right now in making their decisions, how much to actually keep spending going into next year?
Yes, of course. The problem is, again, for many countries in Latin America, countries in South Asia, the spending envelope is very limited. Countries are very aware of the high levels of sovereign debt already outstanding, and with large fiscal deficits, don't want to do a lot more, which then means the burden of adjustment will shift because they've already done as much as they can on the monetary side. On the fiscal side, there's not more room. So it will turn to two other measures. One, they will have to up their ability to restructure corporate balance sheets to try and ensure the debt doesn't serve as a high overhang. That means focus on bankruptcy laws, focus on corporate debt restructuring. That's something they have to do. The other possibility to elevate growth is reforms, especially reforms that allow these countries to benefit from the global market, because industrial countries will be better off. And so perhaps trade and investment, if they can enhance their ability to participate in those markets, that could be another boost to growth. But yes, it is more grim for those countries over the medium term.
Dr. Rajan, I'm sure you've been asked to do this recently and several times in the last few years. If you could put your central bank hat on for me. I'm looking at the PBOC. I can't seem to recall the last time China was the outlook for China was this different from the rest of the world. The PBOC started talking about exiting emergency stimulus next year. Why not? But also why the rush? What would you do if you were in the PBOC shoes right now in terms of, do you normalize policy as soon as you can, or does that almost become counterproductive because everyone else is pretty much stuck at zero?
Well, I take it steadily, right? One of the problems that China has had, I mean, it's been very successful in containing the pandemic, but in order to boost growth, it has relied on the old reliables, more investment, more credit, more exports. And this is something that China wants to get away from. One of the, sort of, depending on how you count, they've added another 30 percentage points of GDP to their debt, various forms of debt over the course of the pandemic. So really, they have to get away from this form of growth to a more sustainable form of growth. If I were the PBOC, I would be gentle about this process. We've already seen some failures, some defaults in the bond markets. I wouldn't want to precipitate too much of that. I want to make the adjustment to a new form of growth, but it has to be steady. It has to recognize the rest of the world is weak, and therefore I would make it in a very measured way, not abruptly.
Dr. Rajan, I can't let you go without asking you about India. You know this economy better than anyone else in the world, so I won't ask you a specific question, but when you look at the situation in India currently, economically, what do you think people need to keep in mind when they look at the situation and the path forward for the recovery in India?
Well, there's a huge amount of euphoria right now in the stock markets in India. There's a sense that the worst is over, and certainly economic growth is coming back quite strongly after a miserable second quarter of the year. But the reality also is the damage that has been done to the economy, the damage to households, the damage to small and medium enterprises will show up only later once, as I said, all these supports go away. So India has to be prepared to act to remedy all that going forward and not get taken in by the euphoria surrounding the pent-up demand that's coming back, surrounding the stock prices, which are high across the world. So I think it's important that you keep in mind a lot more needs to be done in India to set it back on course.